She's back. The one and only and wonderful Anna Kelly is back from her 3-week tour of all things Europe. Anna, we've missed you. Pictures look amazing on Facebook. We are so happy to have you back, and we are even more happy for you having an amazing trip. So, how you doing?
Thank you so much. It's always so good to be back with you. I did have a phenomenal time. It was my first time in Europe. I had been to Russia a couple times on mission work, but never Europe. And so it was a big bucket list thing before I turned 50. And it was everything I dreamed and more. It was absolutely wonderful. Got to have all four of my kids with me. Yeah, there was a little grumbling and complaining, and I pushed too much, and we did too much. But I wouldn't have it any other way, right? When you're in Rome, you do as the Romans do. But
Oh,
I'm glad to be back.
that is awesome. We missed you. We had a lot of craziness go on the last 3 weeks. But I want to
Yes.
open this with talking about the Fed. The Fed is meeting today, Tuesday. Their decision will come tomorrow. Something that has changed since you've been gone is they're calling for 100% chance of a rate cut in September. I mean, well, I think when you left, it was maybe a coin flip. Now it's 100%. There's even talk of a rate cut tomorrow. So I want to ask you, is the Fed cutting rates?
Yes, but not tomorrow.
I like that answer.
I would
Uh,
still say not a good chance for tomorrow, because we had a good GDP report, and we
yeah.
still had inflation come in at 3%. So CPI at 3, I believe, PCE 2.5. So
Mhm.
definitely better on the way down. And we are seeing some recessionary indicators. The SOM rule that I've talked about multiple times is now at 0.43. And anytime that unemployment has gone up 0.5% in 3 months rolling, it's
Mhm.
always indicated a recession. So we're really close there. Yield curve is starting to de-invert, which
Yep.
often happens right as a recession hits. So I think the recession is coming, and that's going to force the Fed to definitely cut rates. I think they do it in September, unless today there are significant layoffs and unemployment just ticks so high in one day. I think there's a fat chance it happens this month, but September, I think, is a pretty good chance.
Yeah, that's certainly where the smart money is. I'm being totally just obstinate saying it's not coming till November. I do think it'll be a
Possible,
half. Yeah, it's possible.
possible.
I mean, the JOLTS report today was okay. GDP was better. Inflation is cooling but not down.
Yeah.
It's I think a lot of
It
people
really
might have
depends on
wishful thinking.
unemployment. To me, it depends on unemployment and whether unemployment finally makes the Fed say, you know what? Yes, we have positive GDP, but unemployment is at a level now that we feel that we need to get ahead of it and not wait for unemployment to become completely recessionary, which would bring GDP, much further down the next quarter. They don't want to cut or not cut. I know they say they're apolitical, and I think for the most part they're trying to avoid being political. But I think if they could, they would push it to November. I think Powell would love to push it until after the election, but I think things are softening enough, with 66% plus living check to check, and the McKelvey rule for unemployment already triggering recession. That's a 0.3 increase over 3 months, and SOM rule getting really close. I know that they're now at the point where they're also receiving letters, saying you're waiting too long, you're about to cause unemployment to get really bad and a deep recession. They're still walking that fine line. I think it's pretty safe for them, unless data changes significantly between now and then, for them to cut a quarter point in September and then wait till November, when things are definitely a little crazier, to really start doing the deeper and steeper and faster cuts.
Yeah. It's really it's just I mean, unemployment's up to 4.1. I think it bottomed at 3.4. So it's
Yeah.
up meaningfully. But I go back to my, econ degree, and we studied it. Full employment was 6%. About a decade ago, that was revised to 5%. We're at
Yeah.
4.1, right? Right. We do get another print on Friday. Expectations are for 4.1, but
And in
it's
fairness, to that point, to people that are saying, y'all are being too gloomy by talking about, unemployment ticking up, when it's still historically pretty low. It really is historically pretty low. However, the history at least shows us if things are going to perform like they have historically, and they don't always, not exactly completely, but history has shown us that when there's a meaningful increase in unemployment from wherever you start, recessions are always right there to follow. Because essentially, once you have a big enough increase in unemployment, and it's not a rate, it's a percentage change year over year that
Correct.
really economists kind of track to see the health of the economy. And you see the other things that we have going on in the economy with, high inflation, cost of living up at least 25%. Some people say with groceries and, gas, it's 300 or 400%. With auto insurance, I've seen 300%. So the basics of living are still up significantly higher, and consumers are squeezed. And when we see this small increase in unemployment that tends to be pretty close to recessionary, at the same time that we're seeing credit card defaults and maxed credit cards and auto loan defaults and people not paying rent and people even foreclosing on properties, all those things together make it clearly, it's like, hello, here's your sign.
Yeah.
Things are not as healthy as they seem, despite unemployment still being below 6%, despite having a positive GDP print. Again, it's a very bifurcated economy. And the question is, how long can it last? How long can the top 20% of income earners keep the economy afloat, and government spending keeping the economy afloat, despite the private sector really struggling 66 to 75% of the economy?
Yeah. It's definitely a K-shaped or bifurcated economy. I think that's become clear. Um, the other thing that I go back to, Jerome Powell 2022, August, where he threw out his Jackson Hole speech and gave that, I don't forget what it was, 5-minute speech, basically saying, I'm not playing, I'm not messing around, we're going higher and going higher fast.
Yeah.
I don't think he's done. I think he is. I think he's trying to go after, the non-banking environment. And I don't,
Sure.
I think, I think he's tired of Wall Street yanking the Fed around. And, it is still my belief that he's gonna wait one meeting longer than everybody expects. So, because he really wants to, you know, make sure there's some pain in the system, right? That's how you clean up things. And
Absolutely. Yeah. And you and I both listen to Danielle DiMartino Booth. She's only one of many economists that I listen to, but she is a Fed insider. And if you
Mhm.
read her book, Fed Up, she talked about how the Fed continues to basically build up asset bubbles, crash the economy, come to its rescue with, bailouts of some sort or another. The proverbial Fed put bailing out Wall Street and
Yep,
all of the non-bank financial system. And she believes that Powell really is trying to break the Fed put,
I
trying to
agree.
say, we're going to let pain happen. We're going to try to stabilize the economy, let the fallout happen where it needs to, especially in that unregulated non-banking system, financial system that is really, for all intents and purposes, depending on how it's measured, it's larger than the banking system
It
is.
is.
It
It is.
controls more of the lending in the market and investments in the market than the banking system does. And so, she as an insider has a lot more experience, obviously, with interworkings of the Fed, but she believes that Powell has his main reason for continuing to kind of soften the negative news and kind of push it with a little more positive spin on the
Mhm.
strength of the economy, is so that he basically has license to keep going, okay, we can hold longer and we will. It's not so much that he really thinks we're going to have a soft landing. We might, again, there's a small percentage, but I think a recession is definitely coming, which would be considered a hard landing. But
Mhm.
if you listen to her, and she gives some pretty good reasons why she believes he does want to go higher for as long as he possibly can, to really leave his legacy as saying, we stopped the era of QE, with full abandon, with
Yep.
no worry about the future. And he has said, we're worried about the U.S. government debt and all the things that could happen that are just going to mean more QE in the future, maybe higher inflation in the future. And I think he's trying to walk a fine balance without saying that that's what he's doing. And so, to your point, if she's right, and I think she is, and I think you and I both agree with that, he doesn't want to cut rates until he can say, now I'm really worried, and he's not going to use those words, but till he
Mhm.
says, I'm really worried that recession is here. unemployment is going to go up drastically, and we might not be able to stop it from getting deep and long if we don't do something sooner than later. So I don't think anything's going to make him pivot unless, and I've been saying this for at least this year, probably into part of last year, until we either have a banking crisis that forces the hand, or we have mass unemployment tick up significantly. And that normally doesn't happen until after a recession is declared. So if it doesn't happen between now and September, I'm with you. I think he could try to push it to November. I just think that it's happening quickly. The layoffs are coming quickly. And I think that by September, he's going to have enough of the unemployment risk, recession risk on his hands that he probably says, okay, I'll give you a quarter point, but I don't think he gives you much more than that till after the election.
So let's try to put some numbers on this. So unemployment as of today, again, we get a new number on Friday, is 4.1. How bad does it have to get by September? Are we talking 4.5, 4.3? I mean, what's bad enough, you think?
I'm not sure all the numbers that he's looking at, but I will say he has kind of made for his number that he has said to kind of, expect that with unemployment of 4 or less, that's a healthy economy. Yes, at some point, we might start to get nervous if it ticks above 4. He used that 4% in a press release. And so we're already there. However, that's on, the heels of GDP print coming in over 2% in the last quarter. And so
2.8. Yep, 2.8.
2.8%. Yeah. And so, I think that's worrisome if it goes much higher. However, in addition to that, the Fed actually is tracking the SOM rule. So the McKelvey rule and the SOM rule that predict recession with 100% accuracy, one is 0.3% month over month for 3 months. One is 0.5. The Dallas Fed, I looked at it this morning, they track on the Fed website, where are we on the SOM rule? And it says it has 100% prediction of a recession. And we're now, at the end of May, which came out in June, we were below the 0.4 mark. It was 0.3 something. So McKelvey rule had been invoked, but not SOM. As of June, which just printed this month, it's at 0.43%. So if the McKelvey rule unemployment starts to show higher than that 4.3 and push to I'm sorry, not the McKelvey rule, the SOM rule, push closer to that 5% or 0.5%. I think the Fed is watching that, and you're going to have enough of the Fed voting members go, we're starting to get really close to that recessionary number. We might want to start to tick. We're comfortable that inflation is coming down. It's time to pull the trigger and make a cut. So if I had to guess, I would still say, unemployment has to tick up. If it stays flat while GDP is increased, that may give them enough to wait till November. If it starts to tick up, I think that's enough to get them to cut at least a little bit in September.
I like it. Well, you talked about Danielle DiMartino Booth. Something she said while you were gone the last couple of 3 weeks is she thinks something pretty drastic is going to break in very short order. We're talking months. And the economy is going to slam into a hard landing. She's I guess I would say she's been leaning bearish for quite a while, I think is fair. But she is now kind of calling her shot, saying this fake economy, all of this stuff is over. Unemployment's going to shoot up. The economy's going to hit a hard landing and, kind of buckle up. And just curious what does that kind of resonate with you? Do you see, I mean, you were just in Europe for 3 weeks. Were people out shopping? Were people happy? What's going on?
Yeah, absolutely. And people are still traveling. So in terms of the travel, I mean, it is expensive, to go to Europe. I mean, it was about
for a family of 6. That is
about $7,000 a person. I did the math. I did the math, right? And that was for just over 2 weeks, 2.5 weeks. And so, that doesn't include shopping for expensive stuff, but I mean, you have very high-end stores on the streets of, Spain and France and Italy, and people are in and out of them constantly, coming out with bags. People are still traveling. However, to Danielle DiMartino Booth's point, and to what you and I just talked about a very bifurcated economy, wealthier people can absorb this inflation better, and we can still travel. It's just the reality of of having more funds, more income to be able to spend, right? We still, keep moving. The other thing is that there was a survey that came out. It was just before I left for Europe. I was pretty shocked by it, actually. And it was a survey of American travelers. I believe it was just Americans. And it said, are you planning to travel this summer? Are you planning to spend more or less money? Are you living check to check? And are you putting your travel on debt?
I
And
saw that. I saw
most
that.
of the people, I don't remember the exact stat because it's been a month, right? But it
Right.
was over 70% of travelers say they
Yeah.
live check to check and they were putting the trip on debt. So just because, to the point of GDP going up, which some people are like, well, how can GDP go up when we be in a recession? GDP goes up, but if you look at the data underneath where it goes up, I did not look for, the July data because I was having too much fun traveling, and I will. I haven't seen it, maybe but in the prints before that, GDP was only really floated by government spending,
Hmm.
healthcare spending. So you pull out government spending and healthcare spending, and I'm sorry, also insurance, auto insurance. Those were the three main things that were positive when everything else, services inflation, consumer goods inflation, they were down. And so
Yeah.
you can have a certain segment of the population spending money and keeping the economy technically above recessionary as a whole.
Hmm.
But when they're doing it on debt and 66% to 70% say they're living check to check, depending on, the survey that was done, it tells you that it's not a healthy economy when almost 3/4 of your population is living check to check, racking up debt in a check that they can't cash into the future. So
Hmm.
I agree with her. At some point, it has to break. And the question we've all been asking is, when is that?
Yeah.
How long can this keep going? And if you listen to Lacey Hunt, who Danielle DiMartino, has a high respect for, and he's been somewhat of a mentor to her as well as the
Hmm.
former president of the Dallas Fed, he's been saying for a long time, there are long and variable lags to the economy. And sometimes we see healthy to recession suddenly, and everybody's shocked, like, oh, we thought it was different this time because it seemed so healthy because the data and the news and the politicians all spin that it's healthy. And then suddenly, but most of the time, when you go back and you look in hindsight, strength of the economy weakens for a couple years before that
Mm.
suddenly happens. And when we have the unprecedented amount of quantitative easing and helicopter money dumped into the system and money on the sidelines that helped many, many small businesses, big businesses, wealthy individuals, poor individuals, a lot of those investors, that investor class and wealthier people, yes, they still have money on the sidelines that's keeping the economy afloat. But when you get to where 2/3, 3/4 of your economy cannot afford a single penny increase and can't even afford what they have today, it will break. It's just a matter of when, not if. So I don't
Yeah.
think we have a soft landing despite the high GDP print. I think that a recession is here, like Danielle does. We've been talking about this for a year.
Hmm.
I believe we're in a recession, and it's just not going to be declared until after the election. They're not going to do it. The NBER will wait till November. But we're in a recession, and the recession tends to get worse when rates stay higher, and only starts to get better when rates are cut. And so usually what happens is the Fed sees in advance that, we're really here. They don't say we're in a recession yet because the NBER declares it. The Fed cuts rates. And when the Fed cuts rates, Michael, that's when Wall Street panics and goes, oh crap,
Ah!
they
Yeah.
cut rates. They know a recession's here. Now we got to prepare for a recession. And then it's kind of self-fulfilling. And the
Yep.
recession usually isn't declared and doesn't get deeper until after the Fed cuts rates. So
Yeah.
that's just history for us. So I think it's going to break. I would bank money on it. I have basically with my
Mm.
investments. I hope that I'm wrong. I hope history is different this time. But I don't think it is. I think it's
Yeah.
going to be a bad recession. The question is how much helicopter money will be printed to get us out of it? How quickly?
Well, let's
Right.
talk about that because not only did Danielle have some words of wisdom the last 3 weeks, Meet Kevin has basically come out and talked about what he's, seeing and calling his shot. Meet Kevin's basically, hey, he's going to buy as much real estate as he can over the next 6 months because what he sees coming, kind of to your point, is a bad recession. And then to your point of helicopter money, they're going to come out and do what they always do. They're going to take rates right back to zero. Meet Kevin has said that he thinks mortgage rates could go to 2% again. And if that happens, we could be on the cusp of a renter nation because his point is we go low again, marginal demand comes back, prices skyrocket again. So that's a lot, but that's kind of he's calling his shot, much like Danielle is. What do you think of what do you think about what Kevin is putting out there?
First, I will show my ignorance in saying I've never heard of me, Kevin. I have no
Oh,
idea who
nice.
he is. Never seen him on anything, never seen print, so I have no idea what his background is. So I hope I don't slam him as being totally foolish, despite not knowing he can know a lot more than I do, right? So I don't know who the guy is. I'll let you tell me after I give you my opinion, right? But
Okay.
I don't think the Fed's going to go back to 2%. I think Cal has worked too long, as we just discussed earlier in this video, to make sure that we don't go back to the zero bound, because the zero bound really is where the problems are created, because it just self-perpetuates, and the debt never stops growing, the federal debt. And that has consequences. And the more QE is put out there, the more money is dumped in the consumers' laps and businesses' laps, the more we will go buy. That will force up asset values, stock values again, et cetera, and create, guess what? More inflation. And then we have the same cycle and the same problem that we have now. This has been this way for decades, and this is what Powell is trying to stop. And so I think as much as it's in their control, they are trying to walk this dance to not have rates so restrictive that it makes the recession so bad that they have to go back to the zero bound, i.e. 2-3% interest rates. I think that they're trying to walk the dance where they have a soft enough landing that they can say, yes, we're in a recession, but we kept it fairly mild. I think that once it's declared, they will cut rates drastically compared to where they are today. I don't think they go back to a Fed funds rate of 1/4 point, 1/2 point, which would get you your mortgage rates in the 2s. I think that they try to give you as high of an interest rate as they can, and that still be stimulatory to get us out of a recession. Because for those that don't understand what the Fed's doing, once you're in a recession, they get you out of it by trying to stimulate you to spend again, despite being afraid of everything that happens in a recession. The only way they get you to stimulate and spend more is they lower interest rates. So you'll say, well, rates are low enough now that even though it's bad, I can go invest and make a profit, which is why we invest, right? And 2, they give you checks. They give you helicopter money. They do what they did post-COVID. And so I think the first round is they try to handle it through fiscal. I'm sorry, through monetary policy, basically, not through fiscal policy. So through the Fed cutting rates. Then if they have to, they'll go to Congress, and Congress will say it's bad. We got to start, helping people with subsidies or different types of things. But I don't think it's going to get that bad. I don't think that it's going to be bad enough that we get those interest rates back. But if we do, if it is that bad, if the banking system breaks, it would be that bad. So that would be my caveat. But if it is, like he says, the first thing I will do is I will go load up on as much cash flowing real estate as I can, and lock in those rates at 30-year fixed mortgages. I won't do variable like I have in the past, commercial loans. I'll try to stick to things where I can get DSCR loans. That means I buy smaller properties, Michael, not the big multifamily stuff that I had been, right? And I'll still buy multifamily, but I'm going to lock in the 30-year fixed rates that I can. I'm going to lock in multifamily deals on a 30-year AM, 10-year fixed through Fannie Freddie. So if you do see rates go that low, buy as much as you can. But here's the thing. Even if they don't go that low, if they go a couple points lower than they are today, which I think is pretty realistic, maybe you see rates in the 5s, high 4s and the 5s instead of in the 7s. I'm still going to go buy real estate, because I think that once you have a bad recession and you have QE and we haven't fixed the fiscal mess, if we don't start raising taxes, regardless of what party you're for, and start paying for the US debt and be able to fund our obligations, the government's going to go into more debt. That's going to cause more inflation. That's going to cause interest rates, treasuries to have to pay higher rates to get people to buy them. And we're going to be back in the inflationary mess and higher rates a few years from now that we're in today. So it's all about locking in rates. If we haven't learned anything through all of this, it's your debt matters and your income, your passive income matters. So you want to build all the passive income you can that's resilient to anything going wrong in the economy that you can imagine, like it has over the last 4 years, multiple ways. And you lock in debt that you can afford to pay with the income stream that's coming in. And that's really the long-term name of the game, no matter when and how much rates go up or down. That's really the key to your wealth.
Yeah. The big thing when I hear Meet Kevin talk about this is all I could see is the 1980s on repeat, right? Inflation spike, they beat it. And then if we did go back to the zero bound or near it, oh, look at that, another spike.
Yeah.
Haven't we seen this movie before? And oh, by the way,
Yeah.
folks, you don't like the ending of that movie because then rates go all the way to like 18% or something crazy to kill it. So
Yeah. Yeah.
I
Challenge today that could make it worse than that, Michael, is that that was not an era of fiscal dominance, meaning the
true.
government
Yeah.
didn't have the level of debt that they have today,
Amen. Yep.
where the actions of the Congress and what they do with money have more impact on the economy than do federal rates, right?
Yeah.
So we now have this double whammy of, okay, there's been a lot of fallout, especially commercial real estate and the banking system. But the government hasn't fixed it and there's no real clear path in sight to raise tax revenues and stimulate the economy and cut spending to get our national debt down. And until that happens, the Fed can do all at once. It's going to make some impact. But I really still believe this next couple of years could be worse than what most people think it can be, just because of the national debt that we have and the situations facing America that Congress has to get a hold of that are going to impact significantly the economy.
All right. So the final one I want to talk about is something that I put out about 2 weeks ago. And that is, I believe, at least in the single family residential market, so 4 units and below, certainly single family, we have entered the first buyer's market in the last 10 to 12 years. I believe what we will see in the second half is a record low transaction volume. I think we're going to take out the low from last year at 3.88. I think we'll go lower. We might even go lower for 2 or 3 months in a row. I think there's a lot of people that are saying, and I'm hearing it almost every day now, I'm out of the game until after the election, right?
Mhm.
The consumer confidence just this morning, a 12-year low for people planning to buy a home. Uh,
Wow, I didn't see
I
that yet.
Yeah, it just came out this morning. It is it's a buyer's market, and people don't realize that's a good thing, right? Less competition, easier to find motivated sellers, easier to do seller financing. So I am getting excited. I think this lasts the rest of the year. We'll see where rates are in the next spring
Right.
selling season. But yeah, I think we're at a buyer's market. I think it flipped while you were gone.
Yeah, I mean, I think we had started to see it in certain regions already, but nationally, you are definitely starting to see, year over year numbers and even month over month numbers. Although prices across, the Case-Shiller 20 markets that they look at and even the 10 are actually up in almost all of those markets, or at least as a whole. I apologize. Certain cities, they're definitely down. And so, I think there are certain markets like I've talked about, Tennessee, parts of Florida because of all the insurance issues, California, Phoenix, Arizona, Austin, Texas. Like they've already been in a buyer's market for months and months and months, but you're starting to see that breadth kind of expand to where it's more national and more cities that days on market are longer, supply is ticking up, prices are actually being cut a couple of times, and people are buying below the listing price in many markets, even though those listing prices might have increased as a whole. So I think we've actually been in this buyer's type of market in a lot of areas that I invest in for several months because rates have just been too high and things don't cash flow, at least when you talk about investment property. Now, single family homes that people still want to move, there's always people that want to buy and sell. They've been tougher, because people don't have to move. They're blessed to sit on those low interest rates unless they're forced to by death or divorce generally, or a job transfer. But now you're starting to see people that are, they're living check to check. They need to move, and interest rates have come down a little bit. They're hoping that they'll come down and they'll refinance. Supply is ticking up, but people are going, I'm just too afraid of a recession and all the things that are going wrong and what's going to happen in the election. I think that's going to slow your buyers and cause prices to fall, which to your point, as an investor, unless I'm the one that wants or needs to sell, that's a good thing. And I think I've said this so many times. I apologize if I've said it on the show, but I still believe in Warren Buffett's adage that you're fearful when others are greedy and you're greedy when others are fearful. And the top of the market, everybody looks like a rock star. And that's really the maximum point of risk. And when you're at the bottom, that's the maximum point of opportunity. So we don't look at recession and say, oh, Anna and Michael are doom and gloom because they think there's a recession. No, we say there's a recession. It's coming. It's going to get worse. Prices are going to fall. And woohoo, we finally get off the sidelines if we had been. And if we haven't been, we prepare ourselves that there's going to be better deals tomorrow. If a recession really materializes and is as bad as it could be, and rates are cut drastically in the next several months, that's amazing opportunity to make lifetime decisions that are going to create massive wealth once you get through this recovery. And hopefully we have something that stimulates growth again. 10 years from now, you're going to be so thankful you bought in the next couple of months.
Yeah, I agree with all of that. And what it's really hard for people to understand the psychology of a buyer's market if you're not paying attention.
Yeah.
Because it's pretty clear playbook, right? So the first thing I tell people is figure out your buy box, obviously, but then look at days on market in your buy box. Like it's inventory is growing, days on market is growing. And at some point, if the average is 15 or 25 or whatever it is, double that. And that's where I'm looking. I'm looking there. Now, there's going to be a couple of sellers that are 50 days on market. One seller wants to sell, but they're not taking price drops. They're basically saying, hey, if I don't get 500, I'm not going anywhere. I'm going to stay put with my 3% mortgage. And that's going to distort the data for a while. That will eventually become an expired listing. However, there's another buyer. He doesn't want to sell. He needs to sell. Those listings likely will have one or multiple price drops. They will entertain or counter what I call disrespectful offers. If there's the right situation and the right seller, they might even entertain seller financing. I am convinced over the next 6 months, my community will do better deals and more seller financing deals than they've done the last year. They'll do more in the next 6 months. That's what I see.
Yeah, I agree. I actually did a women's speaking event where we talked all about seller financing and creative deal structure. And this is the time to do that, while the sellers are motivated. We've had a point where, to your point about it now becoming more of a buyer's market, where it still was kind of a flat market, not either strong seller or buyer, depending on where you are. We're starting to see some motivation in certain cities, but we're starting to see more and more of that. So the more you have many motivated sellers, especially in areas that are hyper supplied, which not all areas of the country are. But if you can find great stable assets, and you know that the market is good for the long term and the asset is good for the long term, and I can cash flow in the way that I structure the deal, sellers are going to be thankful that you're coming in and saying, hey, let me get creative, because they've been sitting waiting for the right buyer who couldn't make the numbers work. And so they had to lowball them to make it pencil. And so, I always look at these seasons, and they haven't happened many times in my lifetime, but the way that I made millions in real estate really was getting very aggressive in the bottom in 2009, 2010. And it's a great opportunity for you to be good to people and create a true win-win, where you're helping out people that otherwise are going to lose their property. And you figure out, how can I structure this in a way that's going to be good for them, good for me, and do it without the banks. And if you can do it without the banks, there's no limit to how many properties that you can buy. And it wasn't until I got really good at seller financing, truly, in probably 2013, 2012, 2013, 2014, that I really started to be able to just continue to buy despite not having a lot of cash to do it. And I still have sellers that I bought on financing that thank me for being the solution to their problem, when they were really the solution to mine as well. So I'm excited about what's coming. I feel like we're finally closer to the finish line, and not like, how many more months is this going to drag on? I tend to think it's going to finish, by the end of this year, November, December, we're going to
Right.
have a recession declared. We're going to have interest rates start to come down. We're going to have more motivated sellers. And it's going to be a really good time for investors who have the wherewithal and the mindset to say, when everybody tells you to run away from real estate and that you're an idiot, that's the time
Mm.
that you run in, right?
Yeah.
That's how you stand apart and really change your life.
Yeah, and again, if you haven't learned about seller financing, I got a treat for you, Ty. Someone on my comes back every Friday on my channel. He did a 6-hour master class on seller financing. It's in the school community. He gave it away for free, so
Awesome.
it's there. I've talked about seller financing a lot in there, so go to the school community, check that out. But yeah, I I just hope people realize that you make your money on the buy, right?
Yes.
Real estate was, the housing market was broken from 2020 to 2023. It doesn't go like this. It's not supposed to do that.
Right.
And this is a lot for a lot of people. This is going to be their first buyer's market because the last one I kind of remember was like 2010 to 12. Once Wall
Mhm.
Street came in, it was over.
Yeah.
Um,
And
but
that's
yeah,
the
it's
challenge, is most people haven't been doing real estate that long, and therefore
right.
they only know what they've seen. I read this and I don't remember where, so I can't give credit to who it's from, but they, just studies of psychology and
Mhm.
and economics and how people react to money. They've only got a window to really look back over the last 10 years. So however it was as normal for 10 years, that's what they just
Yeah.
assume it will always be. So anything that changes paralyzes them with fear to be able to act. Those of
Yep.
us who've known and we've been through, huge economic shifts and gone back and study it, you do learn that these are cycles, they're natural, and they usually are more fast than the one that we lived through post, GFC. The change really has been how do central banks react to them? And does
Mhm.
that make them worse or better? They're kind of they kind of have allowed us through things like QE to have longer expansion periods, but unfortunately a faster fall when they do fall. But we just have to understand that these things do go in cycles. The Fed and central banks and your Congress that makes fiscal policy are going to react in fairly predictable ways, and it's going to take some time. And you have to be patient. You have to play the long game. And the biggest thing is knowing that regardless of everything within you that says fear, 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 right? Danger. When you're at the bottom of a cycle and it's clear, if you have to wait till the recession's declared instead of when Michael and I are saying we think it started, you
Yeah.
might miss the boat on some opportunity, but fine, wait, you're in a recession. You probably have a year or two to steal really great deals. And
Mhm.
even through that recovery, do really great deals, and then you ride it for a few years. So you got to play the long game, understand what's happening, and just don't do deals that are mediocre. Always
Mm.
do great deals in any cycle that cash flow and meet your financial goals, and then hold on to them, right? And
Yeah.
that's really the key to wealth.
Yeah, again, I think single family, we're in a buyer's market. It's time to get creative. It's time to disrespectful offer. It's time to do the work, and the results will come out. It's just a numbers game, follow up, all
Yeah.
of that. Let's switch gears to what I'm planning for 2025, and that's still the 5 to 50 unit buildings. The biggest stuff, Olivia and I own today is 20 units, and I think we're going to buy something bigger. I still think there's a lot of pain out there. I think a measly quarter point, shoot, even a half a point's not enough to save some of these poorly structured or poorly financed deals. Where are we kind of in that pain cycle? I know you're in the syndication space. I know you have a lot of contacts there. I
Yeah.
I really haven't heard much, but I'm guessing it's not good.
Yeah, I would say it's also very bifurcated, just like in the economy as a whole. And so, class A, newer construction kind of deals, I'd say properties that have been value added, at least, from maybe built in the 1990s to 2000s, class B stuff, they're not hurt as badly. The class C properties are really struggling, and we're just at the beginning of that pain. I would say we're maybe through the third inning,
Mm.
out of 7 innings, of where the pain is, because a lot of deals have been able to be worked out with lenders if they're at least fairly stable or their value add plan is very close to conclusion. In fact, I'm an investor in deals that have had capital calls that are going to be okay because of the strength of, the age of the property where it's located and demand for high assets from, commercial buyers like big hedge funds. But there's a lot of pain. And so that does scream opportunity. However, what I found is that's mostly in the much larger properties. So in Class C space and much larger properties. So what you have to ask yourself when you're looking for these 5 to 50 unit things are the sellers distressed? Is the asset going to lose more value if we have a recession? So the Class C stuff, for example, your average person that's living check to check, Michael, who can't afford their rent, who's starting to be behind on rent, and who's not being able to be evicted in a lot of these more tenant-friendly states, the fundamentals of the income are going to get worse when you have a recession. And cap rates don't generally just bounce back the minute that Fed rates are cut. So cap rates have gone up because of treasuries going up and the Fed rate going up. But even if you have a recession and the Fed cuts rates, that Class C kind of stuff, it's not like the cap rate's going to go down and your value is going to go up, because the value of commercial is income divided by that cap rate, or that going rate of return they want on their investment. So what you're seeing in the Class C space especially is tenants who can't pay, tenants moving out, increased vacancy, and that's going to get worse through a recession, increased costs in insurance, in maintenance, because they're older buildings, at the same time that pressure is on that cap rate. And so that's where there's going to be the most pain. There is the most pain. And you have to have the wherewithal to say, I'm going to buy this property and I'm going to hold it long term. That's the key, to where I can get through some more pain, as I'm taking on their problem asset, problem tenants that are having problems, high costs, not able to control some of those costs. The biggest ones, like in Texas, it's taxes. Taxes have gone nuts, right? As well as insurance. Same with Florida. So you have to have thick skin and a good wherewithal to say, I've got enough cash reserves and a good enough business plan and experience that their problem, I'm going to create solutions for, and I'm going to make that asset cash flow. So you got to really focus on cash flow, not appreciation. And I'm going to hold it long enough to where the economy stabilizes, cap rates come back down, hopefully, in the future. And I'm going to be very happy with the long-term investment. But what I don't want people to do is go out and say, oh, this is distressed. The economy's great. It's going to be better. As soon as the Fed cuts rates in a year or two, we'll be fine. And then go buy assets that they don't have the wherewithal to hold. Don't put short-term debt on it. Anything I'm buying over the next couple of years, I absolutely will not put less than a 7 to 10 year fixed rate on it. That generally is enough to get you through a recession, a recovery, and back through an expansion when rates are reasonable. So buy for the long term. And that distress is coming. 5 to 50s are starting to see some stress, especially in Class C markets, but not enough stress yet, because a lot of those smaller assets, Michael, are owned by landlords who have no debt on the property anymore. And so I've been looking for those 5 to 50 units for 2 years. Guess how many I've bought in 2 years? Zero.
Yeah.
Zero. And I do the work. Now I'm picky. I have to have phenomenal deals, not okay deals, right? But I have found zero that are distressed enough that the seller's motivated in any way, shape, or form, because most of them are owned in the smaller markets that I'm in by landlords in their 70s. And they're like, hey, I'm still cash flowing. I have no debt.
No debt.
I don't have the problem you young whippersnappers have because of your debt, right? So if there's more distress, I would love to pick up more 5 to 50 units, even up to 100 units. I just don't see as many of those properties really distressed. And if they are, you need to make sure that the market they're in is really strong and that there's a strong job market. An older property in a really strong economic area is a good thing, but an older property that's distressed and it's in a Class C, C minus D space where it's mostly service workers and not a lot of job diversity and local growth, that's a danger. You need to be careful there, right? But like you, I mean, I want to buy more multis. I want to buy more singles. I want to buy more vacation rentals. I'm going to buy what makes sense for me to buy. And I think there's going to be more opportunity for sure in this next year, and more pain in this next year than there has been. And I'm looking forward to buying a lot more than I have the last year and a half, 2 years.
Yeah, you and me both. I think the other thing that's really important about C class 5 to 50, because I've done this before. We added 60 units or so back in 2012 of this just wrecked units. And you're absolutely right. We may not even be in the third inning. We might be in the second inning, because what's going to happen at some of these units is they're going to be managed by slumlords. And
Yep.
the building might not have been a slumlord last year, but once they realize they're about to lose the property, all maintenance stops.
Yeah.
Right? They just start bleeding the property, because why
Hmm.
put good money after bad? Everything becomes a band-aid versus a capital investment.
Right.
And these
Right.
assets will just go. I mean, so we bought roughly 60 units, and I think 40 of them were vacant over three
Yeah.
different buildings. And just
Right.
the slumlord just he just didn't care. And we ended up getting
Right.
directly from banks. So yeah,
Right.
this is it's you got to have a big stomach, right? Because those are year turnovers,
Right.
right? To
For
kind
sure.
of recycle and take all the crap that's there and just
For
improve it. But
sure.
it's certainly worth it. But
For
you
sure.
do have to have
And I just
reserves.
tell people, be real about your experience level. Where people make big mistakes is they listen to all the gurus that say bigger is better. I'll never
Mm,
buy a 4 unit when I can buy a 400 unit, right? Well, you can make some big mistakes and it not cost you more than, 10, 20, $40,000 on a 4 unit. You magnify that by 100, and you're talking about 400,000, $4 million mistakes, right?
mm,
Take on there It's sexier to say you have more units and to buy a bigger property, but sometimes a smaller units just what created my wealth was 4 unit apartment buildings, one
yep,
after another till I had 100 units, and it took about that much for me to give up the six-figure job. But don't bat your eyes at the small stuff. Buy as big as you can handle, and you have the
yep,
cash reserves and experience or team to be able to handle if you make a big mistake on the purchase price or on what your renovation costs are going to be. And start small, and then
yep,
just buy the next bigger and the next bigger and the next bigger till you build up the wherewithal, the financial wherewithal, and the experience, or at least experience it with a team of partners maybe that you're co-investing with, to really be able to handle bigger stuff that equates to bigger dollars if you make mistakes.
I love it. Anna, this is so much fun. I'm so happy to have you back. I'm glad you got some time
Thank
with the
you.
family. Where can people find you?
Great. I'm so happy to be back. You can find me on your channel. I have a little playlist there. We have, I think, over 5 years of recordings there. So definitely tune in there. You can find me on social media at Anna Kelly, REI Mom. And if you're looking for real estate coaching or consulting, you can find me at AnnaKellyInvesting.com.
Love it. Thanks, Anna.